Welcome. This is Japanese Economic Review Channel. Today, we review the preliminary Tokyo Consumer Price Index for April 2026. While the headline inflation rate sits at a seemingly calm 1.5%, this figure masks a complex tug-of-war between rising daily necessities and strong policy-driven deflationary forces. Let's dive into the structural dynamics behind this data. Looking at the three main indices, the overall CPI rose 1.5% year-over-year. The core CPI also rose 1.5%, but its growth narrowed from March. However, the core CPI, excluding both fresh food and energy, shows a stickier 1.9% increase. This divergence suggests that raw material costs and energy fluctuations are heavily skewing the headline numbers. Here we see the main drivers of inflation. Food is the strongest upward force, contributing plus 1.13 points to the index. Yet, this is heavily offset by a minus 0.39-point drag from the miscellaneous category, driven entirely by free nursery school policies. Without these artificial policy suppressions, our headline inflation would be closer to 2.0%. This matrix details the 10 major expense categories. Food inflation remains high at 4.0% year-over-year, while clothing and footwear rose by 3.7%. Conversely, fuel, light, and water charges fell by 3.0%, and miscellaneous expenses dropped by a sharp 7.1%. This stark contrast highlights how specific sector shocks are dictating the economic landscape. Within the 4.0% food inflation, severe micro-anomalies are hidden. Coffee beans skyrocketed by 60.2%, packaged rice by 41.9%, and chocolate by 26.2%. Dining out, like sushi, jumped 16.2%. These double-digit price shocks in essential commodities mean that consumers are feeling a much harsher inflation reality than the 1.5% headline rate suggests. Policy interventions play a massive role today. The elimination of nursery school fees caused a 100% drop in that subcategory, dragging down the overall index by 0.49 points alone. Additionally, government energy relief shaved off another 0.30 points. Combined, these exogenous shocks are masking the true inflationary pressures brewing domestically. Energy dynamics are shifting. While gasoline prices plunged by 9.9% year-over-year, utility declines are actually narrowing. Electricity fell by 3.0%, and city gas by 6.0%, which are smaller drops compared to March. This narrowing decline in utilities actually acts as a positive inflationary pressure, pushing the overall index up relative to the previous month. Looking at half a century of data, the current 1.5% rate indicates stabilization. We are far below the severe shocks of the 1970s oil crises or the post-pandemic peak of 3.2% in 2023. While we have moved past the deflationary baseline of the 2000s, the current cooling trend suggests that the initial supply-side shocks have largely been absorbed by the market. In synthesis, today's market is defined by friction. The 1.5% headline rate is deceptive. Stripping away policy subsidies reveals underlying inflation closer to 2.0%. There is a clear disconnect between macro stability and severe micro-level cost squeezes. However, with the core index showing a slight monthly contraction, broad pricing power may be softening. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.